Okay, everyone, Assalamu alaikum, and welcome to today's session to prepare to pass. And today is the last day of our session, and we are going to discuss the area of analysis of the financial statements, the area of ethics, the area of framework, and if we get more time, we're going to get an idea of the area of current issues. So these are the four areas that we're going to discuss today. And at the end of the session, we are going to have some tips and tricks of the paper and how to utilize the remaining days before the exam. So this is what we're going to discuss in today's session. Okay, so let's start with the interpretation and the analysis. And the next area that we will be discussing will be the area of ethics. When we talk about the analysis, we are going to discuss the financial performance analysis, non-financial performance analysis, and the area of the integrated reporting. These are three areas which are the part of the analysis. From paper point of view, we are going to have a question of around 7 to 10 marks for the ethics and 10 to 15 marks for the analysis. These two areas will be there in every exam, which is a compulsory area. Apart from this, the question may include either a framework or current issues. But the area of analysis and ethics will always be there. So if we look at the approach which you have to follow to pass the exam, we are going to have a consolidation question of 15 to 20 marks, which will be easy marks. We are going to have the area of ethics, which is approximately 7 to 10 marks, which are again going to be the easy marks. And the third area that we are going to make as the scoring area is going to be the analysis and the interpretation of 10 to 15 marks. So approximately a minimum will be 32 marks and the maximum is going to be 45 marks, which we are going to cover from these three areas. And then the remaining part is going to be approximately 45 to 55 marks for the accounting standards. But the accounting standards are a huge list of the standards. So comparatively, we have to study more for this part of the exam basically. And the remaining part is going to be from the framework and the current issues. So this was a quick overview of how you're going to attempt this in the exams. Ashita is saying, sir, no IS 36, 37, 38. Ashita, actually, these areas are more important than those standards. So we are going to cover these today. Okay, so back to the area of the analysis. So we are going to discuss the financial performance analysis, non-financial performance analysis, and the integrated reporting. When we say financial performance analysis, it has three areas: ratios, cash flow statement, and the additional performance measures, which is known as the APMs. When we talk about the non-financial performance analysis, we are going to discuss the measures which relate to the non-financial performance analysis and how the ethical behavior of a company may affect its non-financial performance. This is the second area. And then in the integrated reporting, we are going to discuss the purpose of the integrated reporting, the principles behind, and the content of the integrated reporting. So so this is the overview of the entire topic that we should be knowing of. Now, when we start with the ratio analysis, this is something which we have covered in detail in the previous exams, which includes your F7 exam, financial management exam, your SBR exam, your P5 exam. So these are the ratios which normally the people are used to. But how we are going to apply it in the exam is something that we need to study and we need to understand. So let's have a quick overview of the profitability ratios. We have gross profit margin as the gross profit divided by sales. Net profit margin as the net profit divided by sales. We have operating profit margin. By operating profit, we mean profit before interest and tax, PBIT. And then we have return on capital employed, which is again PBIT divided by the capital employed. And by capital employed, we mean the equity and the debt. So it is the equity plus the debt. Apart from this, when we talk about liquidity ratios, we have current ratio, which is current assets divided by current liabilities. And we have quick ratio, which is current assets minus the inventory divided by the current liabilities. These answers are usually there in terms of times. And the profitability ratios are normally in terms of the percentages. Then we have inventory turnover. Inventory turnover is inventory divided by cost of sales into 365, which gives us the answer in days. We have trade receivables divided by credit sales into 365, which again gives the answer in terms of days. Then we have trade payable divided by credit purchases, which again gives us the answer in terms of the days. So in the SBR exam, you will not be supposed to calculate the ratios. We will not be supposed to calculate the ratios. Rather, we will be discussing the impact on the ratios without actually calculating them. We will be discussing the ratios without calculating them. Then we have some long-term financial stability ratios, which says the first is the gearing. Gearing is either debt divided by equity or it is debt divided by debt plus equity into 100. Both the formulas of the gearing is the same. This will give different answers, but the analysis will be the same. Abhishek, getting the point? That debt divided by equity and debt divided by debt plus equity will give different values, but its interpretation and the analysis will be the same. Then we have interest cover. Interest cover is operating profit, which is profit before interest and tax, PBIT divided by the finance cost. And when we talk about the investors ratios, this is P ratio, EPS. This may include other ratios as well, but this is just a quick overview of what possible ratios can be. So P ratio is market value divided by EPS. This is going to be in terms of times again. Gearing is in terms of percentage. Interest cover is again in terms of times, and EPS is profit after tax minus the preference dividend divided by the number of shares. This is normally in terms of dollar per share. So this is how we actually calculate different types of ratios. Now what we need to discuss is how these ratios are going to be asked in the exam and what we are going to supposed to do in that case. So if I open the OneNote, and today we are going to talk about the analysis. So in case of analysis, what happens is, let's suppose that we are talking about IES 16. And if I say that there's a company A which actually depreciates the asset on a straight line basis, and there's a company B who depreciates the asset on reducing balance basis or the reducing balance method. Can you tell me what impact this method is going to have on the analysis of the investor? What impact will these methods have on the analysis of the investor? This is a type of question which the examiner is going to ask. An analysis without actually asking the numerical values. Ali Kari is saying that the asset cost will be shown higher in straight line. Salman is saying these are not comparable. Yogesh is saying higher depreciation in initial years. Tasbih is saying comparison cannot be made between the values of PP as they are both different. Okay, yes, everything that you people are telling is actually correct, but this is something which relates to the F7 level analysis actually, not the SBR level. Basically, we say that in case of straight line depreciation, the expense for every year is going to be the same. But in case of reducing balance method, the depreciation expense is going to reduce over the period of time. This means that in case of straight line method, we are going to have lower profits as compared to the reducing balance. We are going to get higher profits in the reducing balance method. So this means that the performance of company B will be shown better as compared to A. The performance of company B is going to be shown better as compared to the company A because its depreciation expenses is actually reducing every year. So its profit will be comparatively higher. Now let's make the question a bit more difficult. What if I say that I am measuring the asset at the cost model and someone else is measuring the asset at the revaluation model? Whose performance will be better? Whose performance will be better? The one at the cost model or the one at the revaluation model? Okay, a lot of people saying cost model and few also saying revaluation model. Actually, the answer is right. The performance of the cost model will be comparatively be better. Why? Because when we talk about cost model, this means that we are going to charge the depreciation on cost directly. But let's say if I say we are revaluing the asset, if the fair value increases, this is also going to increase the depreciation expense and it will effectively result in a reduced profit. So in case of revaluation model, the profit will be comparatively lower as compared to the cost model. So it will give a comparatively lower performance as compared to the cost model. So this means that the profitability ratios or let's say net profit margin of the revaluation model will be comparatively lower. What about the ROCE? What impact will this have on the return on the capital employed? Will the capital employed be higher or lower as compared to the cost model? Am I saying it will be higher in case of cost? Okay, few higher, few lower. Actually, what will happen if we talk about the return on capital employed, it's profit before interest and tax divided by the return on capital employed. And return on capital employed is the sum of the equity plus the debt. Now, when the depreciation increases, this means that the profits will be comparatively be decreased. The PBIT will be reduced because of the higher depreciation. Plus, because the fair value was increasing, this means that my equity is going to increase. So increase in the denominator of ROCE will reduce the return on capital employed. It's actually capital employed only. So the increase in capital employed will actually decrease the ROCE, plus the decrease in PBIT will again decrease the ROCE. So ROCE has two impacts of decrease in case of revaluation model. One, it will be decreased because of the decrease in profits. Other, it will be decreased because of the increase in the capital employed. So it will have a dual impact of the decrease in the return on capital employed. So in case of revaluation model, the profitability ratios, all of the profitability ratios will be comparatively lower. So this means we can conclude that performance in case of revaluation model will be negatively affected. But from the perspective of financial position, we say that the financial position is going to be better in case of revaluation model, because by increasing the assets, the balance sheet assets will also increase. So the financial position is going to be comparatively better. Nimra is saying, please repeat ROC. Nimra, for the return on capital employed, we say that if we have revalued an asset, what will happen? The revaluation gain, increase in fair value, will increase the depreciation, and this will effectively decrease the profits during the year. And because of decrease in the profits, the return on capital employed will also be decreased. Plus, the revaluation gain, the fair value gain, will be recorded as the asset debit and the revaluation reserve credit. So that will actually increase the equity, and it will also increase the capital employed. So increasing the denominator will again decrease the ratio of ROCE. So ROCE will be negatively affected twice, one because of the profit, second because of the capital employed. Is it clear, Nimra? Laiba is saying how financial position will be better. Laiba, because increase in the fair value will increase the assets. This means the higher the assets, the better the position is. The higher the assets, the better the position is. Okay, now what if I say that there was a revaluation loss in case of revaluation model? We are still on the revaluation model, and this time we have a revaluation loss. Now, as compared to cost model, which model will be better? Will the cost model show a better position, or the revaluation model? Okay, everyone is saying cost model, some revaluation models as well. Actually, the answer is that still cost model will be the better one. Why? Because in case of cost model, we are recording no loss. We are simply ignoring the fair value movement. But in case of revaluation model, the loss will be recorded as the P&L debit and the asset credit. So P&L debit means the profits will be reduced. So because the profits will be reduced, this is going to reduce the profitability margins, such as the net profit margin. So as compared to cost model, the net profit margin will be lesser in case of the revaluation model. What about the ROCE? Will the ROCE be better or not? Will it increase or decrease because of the revaluation loss? So PBIT divided by capital employed means equity plus the debt. Now, in case of revaluation loss, the profits will be reduced, and because the profits will be reduced, the ultimate retained earning will also reduce, because all of the profits from the P&L go to the retained earnings. So the PBIT is also decreasing, and the capital employed is also decreasing. Both are actually decreasing. So the net impact be what? Increase, decrease, or nothing? If both are decreasing, the net impact will be what? Increase, decrease, or nothing? Laiba is saying decrease, Abdul Qadir is saying nothing, nothing. Tasbih is saying balance out, Rida is saying nothing. Ahmed is saying decrease, decrease, nothing. Okay. Basically, the answer is yes. This is actually going to decrease the ROCE. The return on capital employed will be decreased. Why? Let me show you. Let's suppose that our ROCE was profit before tax of 10 million divided by, let's say, capital employed of 40 million. So if you use a calculator, it will be 10 million divided by 40 million. The ROCE was 25%. It was 25%. Now let's suppose that we have a loss of 5 million. We have a loss of 5 million. So 10 million minus 5 million divided by 40 million minus 5 million. Both will be reduced. So it will be 5 million divided by 35 million into 100. And if we check the ROC now, it is going to be 5 divided by 35 into 100 is going to be 14.28%. So if we see, the return on capital employed has reduced. Although we have deducted the same amount from the numerator and the denominator. So if we deduct both the values in the numerator and denominator, the net value will be a decrease. Getting the point, everyone? Yes, Tasbiha, you're right. Yes, Amara, the net impact is still significant. It was 25 and it's now 14, or almost half. Now there's one more thing which is very important to be discussed. What if the ROCE was above 100%? What if the ROCE was above 100%? Let's suppose it was 50 million of profits divided by 40 million of capital employed. Let's suppose the return on capital employed was above 100, 50 divided by 40, so it was 125% of the ROCE. And now if we reduce both the values from the numerator and the denominator, 50 million minus 5 million divided by 40 million minus 5 million, so this will be 45 divided by 35 into 100. So now the answer is going to be 45 divided by 35 into 100. If we see, this time it is going to be 128.5%. So if we see, this time the results of the ROCE have improved. So whenever any ratio whenever any ratio is above 1 means above 100%, in that case the impact is going to be same, which means decrease in profits will decrease the ratio, increase in profits will increase the ratio. Getting this point of mine? Or let me prepare a table for you. That let's suppose the ROCE or any other ratio may be above 1 or maybe below 1. So if the profits are increasing, the value, if it's below 1, the ROCE will also increase. It will have the same impact. And if it's more than 1, it is going to have the opposite impact, which means increasing the profit will decrease the ROCE. Increasing the profits plus equity. Obviously, because profits will ultimately affect the equity. Similarly, if the profits and equity are decreased and the value is less than 1, it will also decrease. And if it's more than 1, it will be increased. So if any ratio is less than 1, it is going to be have same effect. And if it's more than 1, it is going to have an opposite effect. Is this clear to all of you? Jagmeet is saying I didn't get it. Jagmeet, according to my example, when the ROCE was 25%, which means 0.25, which means it's below 1, the decrease in profits actually decreased the answer. It was less than 1, decrease in profits, decrease the ROC. And when my ROC was above 100, which means 1.25, the decrease in profits actually increased the ROC. The decrease in profits increased the ROC because our ROC was more than 1. So any ratio which is more than 1, if it's reduced on both the sides, numerator and denominator, it will have the same impact. And if it's more than 1, it will have the opposite impact. No, Mohammed Nabil, you don't have to explain why it's happening. You have to explain what will happen. We are going to tell the impact on the ratio that it will increase or it will decrease. We are not going to perform the mathematical reasoning at the behind. Yes, Sajaki, you have got it right. Okay, now there's one very good question of the past papers which was there in March 2019 attempt. It was March June 2019 attempt. If you people can open that, it was March June 2019. So this is the question I'm opening. Jagmeet, we will not be continuing the hedging because today we are focusing on more on these areas more. So if I go downstairs in March 2019 exam, this is the question of March, but as March June hybrid paper is being published, you can find it as by the name of March June 19 in the on the ACCA's website. So this is a question, basically question number 3 in section B, and it's question number 3 part B that we are going to discuss now, which was of 6 plus 6 12 plus 2 professional marks, which is 14. So it was a 14 mark question in March 2019 attempt. So let's quickly read this. Meanwhile, my mouse is not working properly. Let me ask for a change of the cells. You can start reading and just give me a minute. Okay, so now we are starting to read the question, which actually says, that previous lease standards have been criticized about the lack of information they require to be disclosed on leasing transactions. These concerns were usually expressed by investors, and so IFRS 16 leases was issued in response to these criticisms. So IFRS 16 was being issued to cover the criticisms that the people used to raise on the IASB board. Now, what do we have to do? The question says that in A1, discuss some of the key changes to the financial statements which investors will see when the companies apply lessee accounting requirement in IFRS 16. So what will be the changes in the financial statements if we apply lessee accounting requirement in as per IFRS 16? So we are talking about March 2019, question 3, part B. And let's quickly discuss what actually has changed. In IAS 17, we used to classify two types of leases. One was the operating lease and the other was the finance lease. One was the operating lease and the other was the finance lease. While in IFRS 16, all leases are treated as a single lease, which is lease accounting. Only there are some lease exceptions which are treated differently. Now the accounting of operating lease is the same in the lease exceptions, and the accounting of the finance lease is the same as the lease accounting. So previously a lot of leases were being classified as operating lease, but now only short term or the low value asset lease will be classified in the exception. So effectively a lot of leases which were previously operating lease are now treated as the lease accounting. Sumaira, I don't know what exactly you're talking about. I cannot see your previous message. Okay, so now what effectively will happen that a lot of operating leases will become lease accounting. So previously we used to expense out the lease rentals. We used to expense out the lease rentals. But now we will be recording it as a right to use asset and as a lease liability. And the rentals that we previously used to expense out by making the entry as expense debit and the bank credit will now be made as an entry as the bank debit, finance cost, and the lease liability debit. Plus, we will be amortizing the right to use as the depreciation expense debit and the right to use credit. So effectively, the expense, which was the rent expense, is now distributed amongst the finance cost and the depreciation expense. We used to record the lease rentals as an expense previously, but now we are recording it in the finance cost and the depreciation. So effectively, what will happen if we talk about profit before interest and tax? If I assume that the amount was 100 and now it is, let's say, 10 and 90, let's suppose, I'm assuming them to be the same, although they won't be. But even if we assume that they're the same, what will happen that previously PBIT was being reduced by 100, now it is being reduced by 90 only. PBIT is being reduced by 90 only, and remaining 10 is being treated as a finance cost. So the net impact might be the same, but it won't be the same on the PBIT. The PBIT will now be increased by 10. So this movement will result in an increase in PBIT, but effectively it will reduce the profit after tax. It will increase the PBIT because some element will be charged to the um, finance cost, but the actual profit after tax will be reduced. This is the impact when we move from the operating lease to the finance lease. Sayyida Meg is asking, sir, we don't know about all changes in the standards, how to attempt such questions in the exam. Sayyida Meg, we will be required to know the changes, the recent changes at least, so that if any such question is being asked, we should be able to answer that. Badar is saying that means we should read the previous version of the standard also. Yes, Badar, we have just discussed the previous version. You are not required to understand more than this. This is sufficient enough of the previous IS 17 knowledge that was required by a current SBR student. Okay, Mohammad Faizan wants a snapshot. Mohammad Faizan, you can take the snapshot now. Lau Hong is asking which previous standards need to be revised. Lau Hong, for September 2019 exam, only framework has changed. So that is why you should be knowing the previous framework and the current framework. That will be enough. Ikra is saying, can you differentiate IFRS 15 to Ikra? IFRS 15 is a major change from IS 18 to IFRS 15, so we cannot actually compare it likewise. Alkar, we are not supposed to give numerical examples in our answer. I'm going to write the answer just now so that you people are aware of how to write such questions in the exam. So let me open a Word file and let me save this as well. So we are writing about analysis. Okay. So if I quickly write down the answer of the question, which says discuss some of the key changes to the financial statement which investor will see. So we are going to write as this is June 2019, question number 3, and we are answering part B 1. So we are going to say that due to the change in accounting treatment from IFRS 17 to IFRS 16, the leases which were previously being recorded as an operating lease will now, we can say majority of the leases which were treated as operating lease will now be treated under a single lessee accounting. That is the lease accounting that we have discussed. Previously, IS 17 required to recognize rentals as an expense, but under IFRS 16, a right to use asset is recorded along with a lease liability. So the key changes will be that the right to use asset will be recorded, increasing the total assets of the company, and similarly will increase the liabilities, which will also um, increase in the lease liability, which will also increase the total liabilities. Impact on the net assets would be the same initially, but subsequently in lessee accounting, the finance cost is higher in the initial years, which reduces in the later years. But in IS 17, operating lease, the rent expense used to be the same. So in initial years, the profits of the company would reduce, and in the later years, it will have a net positive impact. Further, the increase in lease liability will also increase the finance cost of the company significantly. Yes, Milos, I will share it. Okay, so this was the answer that we have just written for part B1 for approximately 6 marks, the changes which will be there. Plus, one more impact which is going to be have will be on the ratios, which we are going to discuss in part 2. Alka, the impact of gearing will be discussed in part 2. We can even discuss it right now, but the question was asking about the changes to the financial statements, not the changes to the gearing. So we have told that the finance cost would be changed. We have told that the liability will be changed, the assets will be changed, and we have said that the profits will be changed. We mentioned about the profits over here. So this is what actually the change is going to affect on the financial statements. Yes, Hussein will be discussing the framework too. So approximately we are going to invest 1 hour on each area, 1 hour for the analysis, 1 hour for the ethics, 1 hour for the framework at least, and the remaining 15 minutes, 20 minutes on the current issues. This is what actually I've planned so far. Okay, Kranti is saying, isn't this just a single key change? Will defining the single key change be enough? Basically, Kranti, this is not a single key change because the finance cost is a separate part of the financial statements. Profits are a separate part. Lease liability, right to use are different parts of the financials. Yes, Osama, at the end we'll be discussing the current issues too. Now for part 2, it says for a company with significant off balance sheet leases, which means significant operating leases, discuss the likely impact that IFRS 16 will have generally on accounting ratios. Now we are going to discuss on accounting ratios, but it is saying generally and particularly on earnings before interest and tax, what to interest expense, which means its impact on the interest cover, its impact on the return on capital employed, and its impact on the EBITDA, earnings before interest, tax, depreciation, and amortization. So we have 6 marks for this. So can you tell me what will be the impact on the interest cover? What will be the impact on the interest cover? What will be the impact on the interest cover? Okay, everyone is saying it will be reduced. So actually, yes, basically the finance cost is increasing. So whenever the finance cost increases and the profits being reduced will actually reduce our interest cover on a twice basis. Basically, if I write it over here, so basically interest cover means PBIT divided by the finance cost. So our finance cost is increasing and PBIT is also increasing actually by 10. We actually just discussed over here that the PBIT will be increased and the finance cost will also be increased. But will this increase or reduce the net impact? The answer is decrease, exactly, because normally the interest cover is more than one. So whenever the ratio results in a more than one value, it has an opposite impact. So we are going to say that the interest cover is going to be reduced because of the increase in both the values. Jagmeet is saying that the profit before interest and tax will be reduced because of depreciation. Jagmeet, basically, it will be reduced because of depreciation, but it will be increased because of the rent expense, which will not be recognized now. Salman is saying, why more than one? Salman, normally the finance cost is lower than the profit. Normally the finance cost is lower than the profit. That is why we write the interest cover in times. So all of the ratios which we write in times are usually more than one values. And all of the values which are less than one are normally written in terms of the percentage. Okay, so now we are going to write the answer that the change in the lease accounting will increase the operating profit but decrease the net profit. Further, the increase in finance cost and an increase in operating profit will result in a net decrease in the interest cover. Now, the next thing was the return on capital employed. So, what will be the impact on the return on capital employed? Return on capital employed again means PBIT divided by capital employed, which includes the equity and which includes the debt. So now what will happen? The PBIT is increasing with a minimal value, but the debt would be increasing significantly because we have increased a large amount of the lease liability. So this will actually result in a net decrease in the return on capital employed because the value of the debt will be significantly higher than the impact on the PBIT. So the return on capital employed will be decreased. So we can say furthermore, the return on capital employed will be decreased due to the change as the PBIT will be increased with a small amount, but the debt will be increased significantly, increasing the denominator and hence decreasing the return on capital employed. Salman, that less than one rule actually applies when we are increasing both the values by the same amount. The rule that we discussed would have been applied if the amount of this increase and this increase would be same. But in this case, the increase in the debt will be significantly higher than the PBIT. Let me show you an example that let's suppose that if my lease liability was, let's say, 10 million and my interest rate was 10% basically. So what will happen that the lease liability will be increased by 10 million. But the impact on the PBIT was will be somewhere around 1 million or less or more. So comparatively, the denominator is going to be having a heavier impact. Yes, Algar, you can actually base it on the interest rate as well. So this was a comparatively challenging question, because in the exam you have to use a lot of mind to think what impact where is going to be how. So a lot of what, where, and how in this. And the third impact that the question was discussing was about the EBITDA, earnings before interest, tax, depreciation, and amortization. So when we talk about EBITDA, because we also need to discuss a lot of other things as well, and our 1 hour of the analysis is approximately at the end. When we talk about interest, tax, depreciation, and amortization, what will happen that as per IAS 17, we would be charging a rent expense which would have reduced the profits. But now there is no rent, and that amount will be converted to depreciation and interest, which is being removed in the EBITDA. Earnings before interest, before tax, before depreciation, and before amortization. So now there will be no impact as per the IFRS 16 on EBITDA. So when a rent expense which was previously there will be removed, this means that EBITDA is going to be increased. EBITDA is going to be increased. Like let's suppose if I write that my EBITDA, if I also reduce the rent, let's suppose my profit was 100 million, from where we used to deduct the rent of 10 million, let's assume. So normally previously our EBITDA was used to be 90 million, and now according to IFRS 16 we are not going to deduct the rent. So our EBITDA is going to be 100 million this time. So the EBITDA is going to be increased because of the interest and the depreciation being added back now, which was not previously added. So we can say that with respect to EBITDA, um, the rent expense which used to be recorded previously and deducted from the and being deducted from the EBITDA will now be changed to depreciation and interest cost, which will now be added back, hence increasing the EBITDA after the change. Okay, basically, one important thing is that, which Sabha has highlighted, that we didn't read the complete statement. It was debt to earnings before interest, tax, depreciation, and amortization. So the ratio is actually debt divided by EBITDA. It's not EBITDA, it's debt divided by EBITDA. So what will happen is the EBITDA will actually increase. EBITDA will increase and the debt will also increase now. The EBITDA will increase and the debt will also increase. So if we are talking about debt divided by EBITDA, again the value of debt will be significantly higher as compared to the EBITDA. So the net impact will be that it is going to be increased. This will also be increased because the numerator is significantly higher than the denominator. So let me complete this answer further. As the debt will also be increased significantly. The debt to EBITDA ratio will also have a net impact of increase. Jagmeet is saying, sir, how debt is significantly higher? Basically, if we go back, what will be happening that the impact of the value of the rent as compared to the value of the liability being added in the debt would be different, obviously. The value of the rent that we used to charge as compared to the increase in the debt would be different. That is why we say that both the values are actually not the same. Getting this point, Jagmeet? Okay, Ali Khan is saying, so where to find what changes are being made to the standard so we can solve such type of questions? Ali Kani, the changes, if I tell you the recent changes, the most recent change to date is actually the framework. The change before the framework was actually IFRS 16, which is being asked. The change before that was actually IFRS 15. The change before that was IFRS 9. The change before that was IS 19. But these changes have now been, I would say, that too old to be discussed by the examiner. So this is what which can be discussed. So we have already discussed IFRS 16 change. We are going to discuss the framework change as well. So that will cover all of the changes in the recent attempt. Tasbih is asking, sir, if we write this answer, can we get full 6 marks? Ideally, Tasbih, we should be writing some more because the question also asks some general accounting ratios. So we can actually continue a bit more to get full marks. Like we can say that the net profit after tax margins would be reduced after the change to IFRS 16. So at least we can give one general accounting ratio as well so that we can get the complete full 6 marks. Salman is saying most probable change to be discussed in the attempt is conceptual framework. Yes, Salman, you're right. Kanya is saying that I don't understand how come depreciation is added back because right to use asset is debit. Kanya, because when we calculate EBITDA, what happens? The EBITDA means earnings before tax, before interest, tax, depreciation, and amortization. So if my profit before tax was, let's say, 200 million or 90 million, what we do, we actually add back the depreciation, we add back the finance cost, we add back the amortization to get the EBITDA. So whatever depreciation on the right to use asset will be would have been charged would be added back to get the value of the EBITDA. Okay. No, George, we don't add back the rent normally. If we add back the rent, it will become EBITDA, earnings before interest, tax, depreciation, amortization, and the rent. Okay, so you people can quickly take the snapshot of the answer so that we can move next. We still have a lot to discuss. Okay, so if I go back to the presentation now, these were the ratios that we have just discussed, the financial ratios, the affecting the financial performance of the company. Now, the next thing is the impact of policies and estimates on our financial performance. Actually, the accounting policies and the estimates significantly affect the view presented by the financial statements. As we have just discussed, we discussed two cases, which is we actually discussed the impact of the depreciation method. We discussed the cost model and the revaluation model, and we saw that the view presented by both these cases was significantly different. So this slide is something that we have already discussed in the examples that we were solving. Now the next thing that we need to discuss, Mohammed Siddiqui wants to take the snapshot. Mohammed Siddiqui, you can take it. These handouts are completely uploaded on the handout section of the GoToWebinar. So you can actually download it from over there. If anyone wants to take the snapshot of this, quickly take it. Okay, so when we talk about the usefulness of the statement of cash flows, the statement of cash flows also provide information which is very useful for the analysis because it gives the values which are not available in the financial position or the income statement. Like for example, when we talk about cash flow from operating activities, we actually use the profit before tax and we remove the non-cash and the non-operating values, which actually converts the value into the cash that we are generating from the operations. So let's suppose my profit before tax was 100 million, but my cash flow from operations is only 10 million. This means that the quality of profit that we are earning is not good enough. We are not able to convert our profits into cash. This means that our quality of the profits are not good enough. So not only having profits is important, but the quality of profits that we are generating is also something very important. So according to the cash flow, we can identify what quality of profits are we getting. Similarly, if we look at the cash flow from investing activities, this actually tells us the future prospects of the analysis, because if I'm purchasing assets today, I'm investing in the non-current assets today, this means that these are going to give me return in the later years. So a negative CFI means a positive future, a better future, an increased profit in the future, an increased cash inflow in the future. But a positive cash flow from investing activity means that we are selling the assets today, we are disposing of the assets today, which will result in a decreased profitability and the cash flows in the later years. Because if I sell my asset today, from where am I going to generate the cash? So a positive CFI is normally something which is which we say that uh, should be to be checked that why our cash CFI is actually positive. So it is something concerning for the management. And if the CFI is negative, it is comparatively showing a positive sign for the upcoming years. So profits can be manipulated through the use of judgment and choice of accounting policies, whereas the cash flows are objective and verifiable. We can actually cross-check them from the bank statements. Similarly, cash generated from operations is useful indication of the quality of the profits that are generated by the business. So plus cash flow information has some predictive values as well, which we have just discussed from the perspective of the CFI, that if we look at the CFI, we can get the prediction, we can get the prediction about the upcoming years in a better way. So this was how we can use the cash flow statements. This is how we can use the cash flow statements to actually analyze the financial performance. Now, the next area that we are going to discuss is the additional performance measures, which we also call the APM. These are the additional performance measures. So what exactly is APM? That users of the financial statements in today's world are demanding more information than the simple values so that they can actually analyze better before deciding whether to invest or not. So in today's time, they require more information comparatively. So what further information can be given? We can provide them earning before interest and tax, which actually shows us the operating profit so that they can identify out of the profits what are the ones which we are generating from our core activities and what are the ones which we are generating from other activities. Similarly, we can use EBITDA. Why do we use EBITDA? What is the benefit of using EBITDA? Can someone tell? The pure reason is that is actually it enhances the comparability. How it enhances the comparability? Like for example, if there's a company A and a company B. Company A is following the revaluation model, company B is following the cost model. So the depreciation of this will be higher, the depreciation of this will be comparatively lower. But when we calculate EBITDA, it will actually remove the impact of the depreciation. So now their valuation methods will have no impact on our analysis. Similarly, now their depreciation methods will not affect our analysis. So anything which actually reduces the comparability should be removed before actually calculating the EBITDA. Merrick is saying that this removes non-cash to show quality of profitability. No, Merrick, this is not the right statement. Basically, we are not removing non-cash items. We are removing the items which are creating problem in comparability. We are actually removing the items which are creating a problem in comparability, whether they are cash or non-cash. Like let's suppose maybe during the current year in 2019, the company actually had some impairment losses. Now, these are the impairment losses which were not there in 2018. Now, if I want to show my performance, what we can do is we can say that if we calculate EBITDA, where we are also removing the impact of the impairment, just to see how was the performance in 2019 excluding the impairment loss, because impairment loss is something which was not in our control. Similarly, this impairment loss will not be even there in the next year 2020. So it's a one-off item which is actually creating a problem in analyzing current year's performance and accordingly extrapolating the coming year's performance. So what we do is anything which is creating a problem in comparability, we are actually going to remove that, whether it's cash or whether it's non-cash. Hussein is saying what is A stands for in EBITDA? It's amortization, Hussein. Earning before interest, tax, depreciation, and amortization. So the last A is actually amortization. The SBI is saying to ID earnings less the non-cash item and items that are dependent on regulations. The SBI didn't get your question actually. Now the next thing is economic value added, EVA, economic value added. What is economic value added? Let's suppose that there's a company A and there's a company B. The company A has an operating profit of, let's say, $10 million, and the company B has an operating profit of $15 million. And company A has an equity of, let's say, $40 million, and it has a debt of, let's say, $10 million. So its capital employed is how much? 50 million. And the company B actually has an equity component of, let's say, $20 million and a debt component of, let's say, $80 million. Or let's reduce this half. It's 10 million and it's 40 million, let's suppose. So this also has a capital employed of 50 million. So when we calculate the ROCE, we are going to say 10 divided by 50. What is the amount of 10 divided by 50? 10 divided by 50 is going to be how much? 20%. So the ROC was actually 20%, and 15 divided by 50 was 30%. So if we look at the ROCE, we are going to say that company B is comparatively better than A. But if we see that the company B is comparatively more geared than A, so its risk will also be higher, which means that its cost of capital will also be higher. So let's suppose the cost of capital of company A is actually 12%, and the cost of capital of company B is, let's say, 24%. So what will happen that the investor of company A requires 50 million into 12% as the return, which is $6 million. The investor of company A wants $6 million and they are getting $10 million. So this means company A is actually adding value of $4 million into them. So 50 million into 12% will give us $6 million of the required return, but they are getting 10. So they are getting 4 million above what they required. But in company B, their shareholders, their debt holders required 24%. So they want a return of 12 million and they are getting a return of 15 million. So this means company B is adding a value of 4 million. So comparatively, we're going to say that company A's performance is better in terms of adding value to the shareholders' wealth. Company A is generating more value for the shareholder as compared to the company B. Alistair is saying, so won't the cost of capital be higher for A because they have higher equity? Alistair, this is something that the concept which relates to F9, and this is something not relevant to SBR, but let me tell you quickly that according to traditional method, the increase in gearing actually increases or reduces the debt for a while, but then it starts to increase. So if we are very much highly geared, we may be somewhere over here. Getting the point? Alistair, this is something relating to F9, but not SBR. In SBR, we are simply going to discuss the concept of EVA, not even we will be supposed to calculate. Okay, so if we go back, so EVA actually tells us how much value we are earning above the cost of capital. What value we are generating above the cost of capital for the shareholder. So this is the value added in the shareholder's wealth. The next thing is benchmarking. Benchmarking means that we can set a target in the industry and we can compare it from that, but this is something not very good measure. So I'm completely ignoring that. Then we have net financial debt. What is a net financial debt? That let's suppose we have a company A and a company B. Company A has a debt of 100 million and a company B has a debt of 60 million. So comparatively, we are going to say that company A is more geared than B if their equity is the same. If their equity is the same, we are going to say that A is comparatively more geared than B. But let's suppose A have some financial assets of 30 million which B does not have, and A has cash and cash equivalent of, let's say, 20 million, which is 5 million for B. So if A is having a liability of 100, so it also has some assets of 50, which it can use to repay its debt. So its net debt is net financial debt is going to be 50 million, but the net financial debt of B is going to be 55 million. So if we look at the net debt, we are going to say that company A's gearing would be less than B, assuming that their equity is the same. So if we assume the same equity, the value of A is less geared than B, looking at the net financial debt. So rather than looking at the debt itself, we should be looking at the net debt after incorporating our ability to repay the debt. No, Merrick, net debt isn't the opposite of net asset. Net asset means total assets minus total liabilities. Net debt is something completely different. Shabazz is asking, do we need to know all this? Yes, Shabazz, you need to know all this. Only then you can analyze based on this. If you don't know what exactly the performance measures are, then how we are going to analyze it? Then we have free cash flows. Free cash flows means cash flow from operating activities minus the capex. Capex means capital expenditure. Free cash flows means cash flow from operating activities minus the capex. Merrick is asking what CNC in the net financial debt. Merrick, CNC actually means cash and cash equivalents. It's CNE actually. Cash and cash equivalents. Okay, so let's move further. Now, what are the benefits of actually using the APMs? And similarly, what are the disadvantages of using the APMs? FA means financial asset, Mohammed Siddiq. FA means financial asset. The benefits is that they help to evaluate through the management's eye, because all of these ratios which the management usually calculates on their own. This enables comparison between entities in the same industry if they are calculating the ratios the same way. It strips out irrelevant elements, like in EBITDA, we remove the impact of the depreciation and the amortization because that was actually an irrelevant element for us. And what are the drawbacks? That two entities might calculate the same APM in different way. This is one of the drawback. That maybe there are multiple entities which are calculating the same APM in a different way. Like for example, someone is calculating EBITDA and someone is calculating EBITDAR. Someone is having a different definition of operating profit and someone else may have a different definition of operating profit. Sumaira is saying, what is NOPAT in EVA? NOPAT means net operating profit after tax. Sumaira, NOPAT means net operating profit after tax. Similarly, might be used to present optimistic picture. The management may only show the APMs which show a better picture of the company, and we can simply ignore the ratios which are showing a negative picture of the company. So we can actually create optimistic picture by showing the positive side only rather than showing the negative side. Ali Kani, we can even include it in the management commentary, or we can even show it somewhere in the financial statements or the disclosures. Pooja is asking that is the definition for free cash flows uniform. Basically, Pooja, it is uniform, but the entities actually can use different formulas according to them what they feel is better. Yes, Law Hong, you can say that. Too much of information can be confusing for the user. Maybe sometimes we show a lot of information and the user says, okay, I didn't get anything. Because the more the information, the less they are going to understand. Users may be misled into believing it to be a requirement of IFRS. Maybe some of the users would assume that this is something required by IFRS, although there is no APM in any of the IFRS. These are all additional measures that we are willing to show in the financial statements. Okay, so let's quickly cover this. It's already 9:26 and we have only 4 minutes before the break. And I personally would prefer starting the framework after the break so that we at least have sufficient time to do that too. Now non-financial performance measures are comparatively very easier. You can study this at home. So this is a self-explanatory slide. You can study this at home. But we will be extending the session for a few minutes, approximately 15 to 20 or maybe 30 minutes. So without taking a break, it will be very difficult for everyone to study on a continuous basis for 3.5 hours. Now let's discuss a bit of the integrated reporting. What exactly integrated reporting is, that in case of a company, a lot of stakeholders require different type of reports from the company. Like different stakeholders requiring different reports, such as sustainability reports. The companies usually give these reports in the financials. CSR report, social report. These are all types of different reporting that we provide in the financials for different type of the stakeholders. But all these reports, having different reports, is a cost to the company because we incur the cost to prepare that. Similarly, this also results in duplication of the information, because sustainability may be a reason of of being corporate socially responsible for the company. So what happens that preparing different reports will have additional cost, may have repetition of the information, and the repetition of information reduces the quality of the financial statements. It reduces the relevance, which is a qualitative characteristic of the financial statements. So we prefer that that the information should not be repeated everywhere. So a concept of integrated reporting was introduced, that what if we create a single report that covers all of the stakeholders requirements. So integrated reporting has been developed with this concept, that let's prepare a single financial which already covers uh, the information relevant to the every shareholder, whether it's to the every stakeholder, whether it's a shareholder, whether it's a lender, whether it's a creditor, and anyone else. So integrated reporting has actually added all these values together in the integrated report. So an integrated report explains how an entity creates value over the short term, medium term, and the long term. This is the drawbacks picture. Monica, quickly take it. Lao Hong is asking that how sustainability and environmental report benefit to stakeholders. Lao Hong, the answer is pretty simple for that. Like, let's suppose you are a shareholder of a company, and you know that your company is actually cutting trees every year without actually reproducing them. They are cutting trees to let's suppose prepare papers to be used in day-to-day life. And you are a shareholder, you know that if they start to cut trees and not generate new, a time will come where when all of the natural resources from the world will be eliminated, because this would mean that consuming the natural resources without regenerating them is a short-term task. One day the resources will be finished. Similarly, if we talk about oil industry, the oil resources are limited in the world. If we extract all of the oil today, our coming generations will not be sustainable. They won't be able to live in the world without the natural resources. So it is our responsibility today to ensure that that the natural resources we are using should be regenerated somehow, to ensure that the world continues with the natural resources till its end. Getting the point, La Hong? So being a shareholder who is more ethical would want to invest in the companies who are also ethical. I would not want to invest in a company which actually creates a problem for the people. So the nature of the shareholder will decide what type of the companies they would want to invest in. Okay. Ali, can you say how will apply IR and SBR? We know capital and objective, but how to apply? Sustainability reporting is similar to CSR report, some sort of basically. LIBA CSR means corporate social responsibility. CSR means corporate social responsibility. So the fundamental concepts underpinning the IR framework are the capitals, such as the human capital, the financial capital, and the natural capital. These are different types of capitals that a company usually uses in its operations. So the IR framework says that all of the resources that a company uses are the capitals. Either it is using the employees, which is the human capital, or the natural resources, which is called the natural capital, or the cash being invested by the shareholders and the debt holders, which is known as the financial capital. So all of the resources being used are the capitals, which the company should tell what capital, what inputs are they using. Plus, we should tell what is the organization's business model, what are the processes where we use these inputs, these capitals, and how do we create value over time? How do we pay back to these capitals that we have used? So integrated reporting is a report where we tell what capitals are we using, what use do we make out of them, and how do we pay them back at the end of the year. So this was the basic concept of the um, integrated reporting. We have already discussed the capitals area. You can study this. Now the important thing is what content should be disclosed in an integrated report. So this is what should be read. An integrated report must identify key inputs, such as employees are the key inputs or the natural resources are the key inputs of the company. It should tell the business model, being the process, the business activities that we are following. It should tell us the key outputs, what products and what services does our company provide. What are the outcomes, which means the consequences as a result of the entire process, and how it creates the value for all of its stakeholders. So this is the content of the integrated reporting that should be disclosed. So this will help the shareholders or the stakeholders to understand the direction of the company, and they are going to decide whether they should be investing in the company or not based on that. Yes, Lahong, these are all areas which are related to SBL, but obviously are a part of SBR approach too. Vishal, you can take the snapshot. Now let's take a break. It's 9:36 on my side. So we're going to take a 10 to 15 minutes break and then we are going to continue back. Okay, everyone, welcome back and let's continue now. So we had discussed about the integrated reporting previously, and that was all related to the area of the analysis. And let's discuss the area of the framework now. So that is the next important area. Okay, so now let's discuss the area of the framework. Framework is basically an important area for the current attempt as well. The first thing about the framework is that the last framework was relating to 2010, which was actually created in 1989 and last updated in 2010. So in 2018, the framework has actually replaced that, and now we are going to study the new framework. But I think I have opened the wrong presentation. This is the old framework. Let me correct the presentation. Just give me 2 minutes. I mistakenly opened the wrong area. Okay, so let's start now. So the framework, the current framework of 2018 now is being changed and it is examinable from September 2019 exam session. The previous one was 2010 conceptual framework, which is not no longer examinable, but the examiner can ask us the difference between the previous one and the new one. Salman is asking that the one that you have uploaded is the new or the old. I think that would be the new one. Let me also check by downloading that. So this handout is the new one, yes. The handouts uploaded to the system are the new one. Okay, so now what are the changes in the revised framework? The main changes are actually the new definition of elements to the financial statements. This is one thing which has changed. Guidance on derecognition has been added in the new framework, and there's some considerable guidance on the measurement now as well, which was not there previously. And we have introduced the high level concept of the presentation and the disclosures, which was not there in the previous framework. So now, what are the new areas, the content of the framework, the new one? There are total 8 chapters, chapter 1, 2, 3, 4, 5, 6, 7, and 8. which have now been introduced in the framework. Chapter 1 tells us the objective of preparing the general purpose financial reporting. General purpose financial reporting means the financial statements, that why are we preparing the financial statements? What are the qualitative characteristics of the financial statements? What exactly are we going to make in the financial statements, and what is the reporting entity? What are the elements? When do we recognize and de-recognize the asset and the liability? How do we measure that? How to present and disclose? And the last thing is that the concept of capital and capital maintenance. So these are 8 areas that we need to discuss actually. But before that, let's discuss the importance of framework. Let's discuss the importance of framework, that why has the IESB board actually prepared the framework. Okay, Cindy will update that. Now, what is the importance of framework? That the conceptual framework is the set of theoretical principles and the concepts that underlie the preparation and presentation of the financial statements. So the first thing is that basically the framework is the theoretical rules, principles that the standard is going to adopt when it is being developed. If no conceptual framework existed, then it was more likely that the accounting treatment would be produced on a haphazard basis. Basically, framework is the boundary given to the standard that look, you have to make a set of rules based on these. So this is a type of a boundary given to the standards, that you have to remain in between this while making the standard. Similarly, accounting standards might be inconsistent with one another or perhaps contradictory if there was no framework being published. It also acts as a reference point for the preparers of the financial statements if no adequate accounting standard exists. Although this is something very rare, but if there is any issue not being covered in the accounting standard, then we can refer to the conceptual framework to cover that. And then our objective is to help the standard setters, which means the body which is going to prepare the accounting standards, when they are developing new standards or when they are updating the standards. Similarly, it also assists the auditors when they're on the audit of the company. So the objective is to ensure that there are boundaries given to the accounting standard setters, so that we can provide support services to the auditors and the accountants, so that the standards are made in a consistent way, so that they are not contradictory with each other, so that the basic principles behind should be known to everyone. So these are the rules that why the framework has been created. So now if we start from the objective of the financial reporting, the objective of financial reporting is to provide information to the existing and potential investors, to the lenders, and to the other creditors. These are called the key stakeholders, the key users of the financial statements. So we are going to prepare the financial statements mainly for these 3 types of the users. This will help them when making decisions about providing resources to an entity. Now this objective is the same as the 2010 conceptual framework, but the concept of stewardship has been introduced as a new area. The stewardship actually means the responsibility of the directors of ensuring that the company is moving in the right direction. So stewardship concept has been introduced, that along with the objective of providing companies performance, the objective is also to provide the performance of the directors. Like for example, if you're sitting in a car and the car is not working fine, so there are 2 possibilities: either the problem is in the car or the problem is in the driver. So maybe the company's financial performance may not be good, not because it didn't have the potential, but maybe the directors were not working fine. So the objective of preparing this reporting is both to analyze the company's performance and to analyze the director's performance, that how well are they fulfilling their responsibilities. Getting this point, everyone? So the primary users need information about resources of the entity, not only to assess entity's prospects for the future cash flows, but also how effectively and efficiently management has discharged their responsibilities of using the resources. Exactly, Lao Hong. How well are they basically performing their fiduciary duties? Now, the next thing, chapter number 2, is about the qualitative characteristics. This is approximately the same as the previous one. Now, there are two types of qualitative characteristics: fundamental characteristics and enhancing characteristics. Fundamental characteristics are the one that should be met by every standard, and enhancing is the one that every standard should try to fulfill, but if there's a contradiction, there's no harm in ignoring that. Now, there are two fundamental characteristics. The first is the relevance, and the second is the faithful representation. Relevance means that all information which is relevant to the decision maker should be given in the financials, and any information which is not relevant should not be given. So only relevant information and all relevant information should be given in the financial statements. This is the core objective of this characteristic. So we say that the information is relevant if it impacts the decision made by its users. So if the information affects the user's decision, that will become a relevant information, and if it doesn't affect the user's decision, that will be an irrelevant decision. So relevance is supported by materiality consideration, which means that all material items are relevant. But when we say material, this includes two types of materiality. Few things are quantitatively material and few elements may be qualitatively material. Like for example, a fraud, a fraud of even $1 is going to be material qualitatively. $1 is not an issue, but how did the company did a fraud? This is the issue. It's a qualitative question being raised onto the company. So quantitatively material means numerically material. Qualitatively material means non-numerically material. The second thing is that Salman is saying qualitative mean material by nature. Yes, exactly. The second thing is that the financials should be faithfully represented, which means they should show true and fair view. Faithfully represented means showing the true and fair view. And this can only show the true and fair view if they are complete, if they are neutral, and if they are free from any material error. Plus, faithful represent also means following the prudence concept. That if the financials are being prepared based on the prudence concept, this means that it is faithfully represented. And if it is based on the substance over form concept, only then we are going to call this faithfully represented. So the financials are going to be faithfully represented if they're following the prudence concept, if they're following the substance over form concept. Apart from that, the enhancing characteristic includes comparability, that the financial statement should be comparable. Comparable with whom? Their own last year, plus comparable with the industry. So the financial statement should be comparable with their own last year and they should be comparable with the industry. Verifiability means that the values in the financials could be verified. somehow. Obviously, it is not our responsibility to verify that, but this point is to ensure that it is more easier for the auditor to verify that values. Yes, George, exactly. The third thing is timeliness. Timeliness means that the financials should be available in the market as soon as possible in a timely manner so that the shareholders can take decision at the right point of time. Plus, the financial statement should be understandable to the users. This means that we should not be writing so difficult English or should not be writing incomplete disclosures, incomplete values that it is not understandable for the users completely. The bill comparability means um, that the financials should be comparable with other companies in the industry and our own last year. Like for example, if we talk about IES 8, in case of change in accounting policy, we treat this retrospectively. Why? So that the financials of current year are comparable to the last year. So the concept of comparability is used by IES 8. Similarly, IES 1 requires the company to produce two financials in 2019. It should also produce financials of 2018. So this is what is enhancing the comparability. Sabha, we will discuss the substance over form in the next slide. Verifiability basically means that the values should be verifiable by the auditor. Like for example, according to IFRS 9, if we talk about the case of hedging, there are certain criteria which should be met for hedge accounting to be applied. One of those criteria includes that there should be a formal documentation that we are going to hedge um, whatever item it is. The hedged item, the hedging instrument, and the hedge type should be documented. This is a requirement of IFRS 9 so that it's easier for the auditor to verify that the intention of the company is hedging or not. So if the document is there, the intention is hedging. If the document is not there, the intention is not hedging. So it will become very easy for the auditor to verify whether the documentation is prepared or not. So verifiability means that the financials the values and the procedures and the accounting can be easily verified by the auditor. Okay, now the next thing is that there can be certain cost constraints because what will happen, the more qualitative areas we are going to improve, the more is going to be the cost. So we say that it is important that cost incurred in reporting financial information are justified by the benefits that the information bring to its users. So this means if I want to increase the comparability, the benefit of enhancing the comparability should be more as compared to the cost incurred to make the financials comparable. So we always have to look at the cost constraint that the information that we are disclosing, ensuring qualitative characteristics should have cost benefit. Yes, Ali Yani, cost benefit analysis, we can say that. Now, there were two concepts, prudence and substance over form, which were actually removed. These were removed from 2010 conceptual framework, but now they are being reintroduced in the framework again. Long this is something subjective. We cannot quantify that how much benefit are we getting. This is something subjective. Non-financial benefits actually it is. So the prudence and the substance over form concept were reduced from 2010 conceptual framework, but these are now reintroduced in 2018 conceptual framework. Now, what are these concepts? That's pretty simple. That prudence is often interpreted as meaning that the entities should not overstate their assets or should not understate their liabilities. We should not overstate the assets and we should not understate the liabilities. This is what is called to be the prudence concept. And the substance over form concept is that the transactions should be accounted for in accordance with their economic substance rather than their legal form. Like let's suppose in case of leases, what happens that A gives the right to use of the asset to B and receives the consideration. Now legally the asset belongs to A. Legally the asset belongs to A, but in substance A will never gain the benefit from the asset. Rather, the benefit from the asset will be gained by B. So that is why we say that this is not an asset for A as per the substance over form concept. According to the economic substance, A will gain the benefit from the rentals and the GRV and the UGRV, but it will not gain the benefit from the asset itself. So that is why legally it belongs to A, but economic substance says that it does not belongs to A. So this is why we actually de-recognize the asset from the finances of A in case of a finance lease. Yes, now the examiner can actually ask us the difference between 2010 and 18 with respect to the prudence or the substance over form. Now the chapter 3 is about the financial statements and the reporting entity. This is something very easy, that it says that the useful information is provided in the statement of financial position, in the statement of profit and loss and the OCI, and other statements and notes. Other statement means the statement of cash flows and the statement of changes in equity. Yes, Cindy, I remember this now. So according to the framework, the useful information is provided where? In the balance sheet, in the income statement, and other statements and notes. By notes, we mean the disclosures. By notes, we mean the disclosures. Now, the financial statements are prepared for a period of time. Period of time means it may be a full year, it may be a half year, it may be a quarter year, or any other, maybe monthly, but it should be for a period of time rather than being as at. Ali Kani is asking that, so there is no difference in the framework. Ali Kani, this is entirely new area because the framework, old framework did not mention about the financial position, P&L, OCI, and the disclosures. It only mentioned the old framework 2010 that we should be showing the financial performance, position, and change in the financial position. There was no name of the statement of financial position, P&L, OCI, or the other statements in the old framework. Okay, Salman. Yes, Alka, basically the financial position is as at, but financial position is not something which is prepared on a standalone basis. We always prepare a complete set of financials, which includes P&L, OCI, cash flow, Soci, and the notes. Sumaira is asking cryptocurrency, is it important? Sumaira, everything is important because there was an article on the cryptocurrency so that we can say that it is an important area as well. It might be asked in the exam. Plus, the second thing is that the financial statement should be prepared with comparative information. This means that if we are preparing the financials of 2019, we should give a comparative of 2018. In 2020, we are going to give a comparative of 2019. In 2021, we are going to give a comparative of 2020. So every time we need to prepare the financials, we need to actually show the comparative figures. And then there is an assumption that the entity will be prepared on an assumption that the entity will continue operations for the foreseeable future. By this, we mean the going concern assumption. This is the only thing which was there in the old framework. Everything else is completely new in the new framework. Muhammad Saqib is asking what was the need of introducing chapter 3. Basically, Muhammad Saqib, this is what is mentioned according to IS 1, and all standards are based on the framework. So anything which is not mentioned in the framework cannot be adopted ideally by any standard. So if IS 1 is talking about that, so it should be there in the framework first before any standard actually adopting that, because framework is the boundary in which the standard should be ideally staying. So if the standard is actually crossing the boundary, this means that the boundary should be extended. So that is why they introduced the step 3. Now the next thing is, what is a reporting entity? Reporting entity is the entity who must or chooses to prepare the financial statements. So the entity which is preparing the financial statements is called the reporting entity, and it can be a single entity or it can be a portion of an entity. That is, it might be a division, it might be a product, it might be any location, it might be any a strategic business unit, an SBU. So if any portion of the company wants to prepare its own accounts, there's no harm following the standards onto that too. Similarly, a reporting entity can be more than one entities, like group of entities. So what is a reporting entity? The entity which is preparing the financial statements, which can be a single entity, which can be a portion of a single entity, and which can be multiple entities. Laiba, you can take the snapshot quickly. George is saying what is meant by must be or chooses. Basically, George, if we are a division of an entity, are we required to prepare the financials? The answer is no. So we may choose to prepare the financials on our own, although there is no legal requirement for that. But if I'm an entity, a listed company or an unlisted company, but a registered company, I must be preparing the financial statements. Similarly, the group is also required to prepare the financial statements. So in some cases, if an entity or a part of entity is not required to prepare the financials, but it still may opt to prepare them, there's no harm in that. Yes, Sardar, EDs and current issues are actually the same. The only thing is that there are two practice statements as well, which are there in the current issue, so they are not ED. There are certain EDs, discussion papers, and the practice statements, which are actually a part of the current issues. So in total, we have two practice statements, one discussion paper, and the remaining are the exposure drafts in the current issue. but these are all small areas, not very much technical. So there's nothing much to worry about that. I will share at least the presentation of this so that you people can at least study at home, even if we are unable to cover that. Sam, you can find the list of EDs in the syllabus actually. Yes, Ali can. Yeah, I will provide the notes. Okay, so let's move on to the chapter 4. Chapter 4 is the elements in the financial statements. In this, the definition actually has changed, and everything else is the same. The definition has actually changed, that according to the framework, there are 5 elements of the financial statements. The first is the asset. An asset is a present economic resource. The previous framework used to say said that the asset is a resource, but the word economic has now been added, controlled by the entity as a result of past event. So the probability rule, the probability criterion has actually removed from the previous standard, from the previous framework. The old framework 2010 required that the asset should be recorded if there's an economic benefit being probable. But the problem was that the framework used to say that asset is one where the economic benefit is probable. But let's say if we talk about IAS 37, 37 says to record the asset when the inflow is virtually certain. Now there is a conflict between both of them. Similarly, IFRS 5 says that record the asset held for sale if the sale is highly probable. Now someone is saying probable, someone is saying highly probable, someone is saying virtually certain. And IFRS 3 even records the contingent asset in the financial statements at the date of acquisition. So it records the asset when the inflow is probable. And IFRS 16 or IFRS 15 includes the values it is when it is again highly probable. So all these standards are actually contradicting with the framework. So framework is the only one saying probable. Everyone else is saying either highly probable or virtually certain, and IFRS 3 is saying possible. So to remove this contradiction, the IASB board actually removed the probability criterion from the definition. Rather than updating so many standards and changing those, they changed the framework. Yes, Saim, these slides are more than enough to read the framework entirely because I have ensured that all of the relevant points are being covered in these presentations. Okay, Crystal, I will share the handouts on the WhatsApp group. Lao Hong is saying remove or not, it still follows IFRS. Yes, exactly. The IFRS is still the same. Only the framework has been removed because no one was listening to it actually. The framework was saying probable and everyone else is saying its own. So the framework actually stopped saying probable. Mohammed Nabil is saying, how are we going to be examined on the framework? Nabil, there are different ways. Maybe the question says um, that it gives you a case and says that, okay, this is the case. What is the treatment according to the old framework and what is the treatment according to the new framework? And what is the treatment according to the standard? Because everyone is having different rules. So it may ask you a case accounting based not on the standard, on the framework, that if I apply the framework, what will be the accounting treatment? This type of question can be asked. Annie is asking, how can I join the group? Annie, you can drop me an SMS on my mobile number. And today I will get free from my classes. So tomorrow I'm going to add everyone who has not been added yet. So you can drop me an SMS on the WhatsApp and I will be replying to every one tomorrow because I will be free in tomorrow's day. Okay. Similarly, what is a liability? Liability is a present obligation of the entity to transfer an economic resource as a result of past event. Again, there was a probability criterion. Criterion means a criteria previously in the old framework, which has now been removed. Now, this is something that you have to request ACCA. This is entirely their decision. Now, if we talk about equity, income, and expense, these three definitions are the same as the old framework. So there is no change in this. This is entirely same as the previous framework. Now, chapter number 5. Chapter 5 talks about the recognition and derecognition. As per the previous framework, derecognition is something which is new, and recognition criteria have actually changed as compared to the previous framework. Salman is saying what depends on ACCA. Actually, Law Hong was asking me to keep another session of 1 to 2 hours. So I said that that depends on ACCA. Onam is saying, sir, will these definitions also change? IS 3616. Basically, Onam, the framework has actually changed because no one was listening to that. So there will be no change in IS 1636 and other standards. Only the framework has changed. Muhammad Saqib is saying at the end, I will request you to please advise on how we should prepare. Oh, yes, I will, Muhammad Saqib. Muhammad Saim is saying, whoever practiced from BPP or Kaplan Kit up to this, are they updated? Yes, Saim, they are updated. The June 2019 are not updated. The framework and the current issues will need to be changed if you're using the previous study texts. Sarah is saying, hi, I'm listening to your lectures and I've tried to message you on WhatsApp for the actual lecture presentation, but you haven't been going through. Actually, Sarah, the problem was that since Monday till today, Friday, consecutively, I am have been teaching approximately 15 hours a day. So out of 24 hours, I'm teaching 15 hours and only 9 hours are left. So when I go home, I have no more energy to reply to anyone. So I'll be replying to all of you people tomorrow. So I apologize for the delay from my side and I thank you all for the patience. But it's just one more day. Tomorrow I will be answering to everyone. Yes, Long, same goes for you too, because I am the one who's personally replying to the students. So I cannot actually hand it over to someone else. Okay, so now chapter number 5, the recognition criteria has changed, which says recognition means including an element of the financial statements in the financial statements. Obviously, an item is recognized in the financial statements if. So now we have these 4 criterias, where the first criteria is it meets the definition of an element. It meets the definition of an element. Okay, Marek, I have noted you. So the first criteria is that it meets the definition of element. It means that the definition that we have just discussed. So we should be recognizing asset if it meets the definition, plus the recognition of asset will provide relevant information about the element. So if it is providing relevant information, then we should be recognizing the asset. Otherwise, we should not be recognizing that. This is the previous slide. Annie and Rebecca, you can take the snapshot. So we should be recognizing the asset or any element, maybe liability or income or expense or equity, only if it meets the definition. Its recognition will result in relevant information to the user, which means that they are material in numbers, because relevance means materiality concept, and provides faithful representation, which means that they are based on the prudence concept or they are based on the substance over form concept or any other concept which ensures faithful representation, plus the benefit of recognizing to the users will outweigh the cost of preparation. Like let's suppose let me give you an example that normally in companies they make a range, like for example anything below $1,000 will be expensed out. The companies they make a policy usually and they make a range that anything below this range they expense out, although even if they are buying an asset they would expense out. Why? Let me give you an example that if you have purchased a calculator, if you have purchased a calculator, obviously all of you would have, is this an asset or an expense? Is calculator as an asset or an expense? What do people think? Laiba is saying it's my asset, Sabah is saying asset, Ali Khan is saying asset, George asset. Okay, everyone is saying asset. So the answer is yes, it is an asset. But what if you record it as an asset and then you say, okay, it has a life of 5 years, so I will depreciate it every year. Will that accounting be any useful to you? If you have purchased a calculator and you say that it is a calculator of let's say $50 and it has a life of 5 years, so we are going to depreciate it for every 10 years, recording an accounting entry, and for that you need to hire an accountant who uh, who is going to take an amount from you, and then it will prepare a financials for you. So we say that what's the use of that? Because it's easier to expense the calculator out because there is no use of writing it as an asset. So recognizing the calculator as an asset will have more cost than its benefit. So we say that we should not be recognizing every asset, rather we should recognize an asset which has more benefit than the cost. Yes, Ali Gani, we can say that the low value asset should be expensed out, but low value means a different value for every company. Everyone will have a new definition of low. So we do not recognize every asset. We are going to recognize the asset on which we have more benefit than the cost. So based on cost benefit, we are going to decide what to capitalize, what to expense out. Myra, you're right. Okay. So now the next area that we are discussing is the derecognition. An asset is derecognized when it no longer meets the recognition criteria. So an asset should be derecognized when it no longer meets the recognition criteria. So the derecognition means removal of an asset or liability from the statement of financial position, and when actually it is removed, in case of assets when the control is lost, and in case of liability when there is no longer a present obligation. Yes, Marek, we will be extending past the time that we had planned today. So derecognition is pretty simple. When the criteria are no longer being met, we are going to derecognize. Normally in case of assets when the control is lost, in case of liability when the present obligation is no more there. Now the next area is the measurement. Measurement means at what amount to recognize the asset or the liability or the equity or the income or expense in the financials. The framework discusses two basic measurement bases which is the historical cost and the current value. Now, if you talk about the previous 2010 framework, it had four measurement techniques: historical cost, current cost, which means the fair value, present value, and the net realizable value. These were four values which which were the measurement techniques allowed by the previous 2010 framework. Long, you can take the snapshot, Krantivir. So according to the old framework, there were four measurement techniques: historical cost, current cost, which is also known as the fair value, the realizable value, and the present value. Now, do you think is there any value left which we use in the standards but was not there in the framework? Can you tell me any technique which we use in the standards but was not there in the previous framework, which is not there out of these four? Any value, any technique? Okay, value in use is basically the present value. So the value in use is actually covered in the present value. No correct answer so far. Basically, expected value. Expected value is something which was not there in the previous framework, because we take the expected value in case of the consolidation. If you remember, in case of contingent consideration, we record the expected value. Similarly, in case of IFRS 15, we record the expected value. So expected value is something which was not there in case of the old framework. So Mera replacement cost will be covered in the current cost. So every value was there, but not the expected value. So what happened? The framework actually changed the concept, and they said, okay, from now onwards, there are only two methods: historical cost and current value. Now, this current value includes the fair value, the present value, the expected value, the value in use, and every other value that is that relates to today's time. So either we take the original cost or we take any value of today's. That is fine with us. So framework has changed from four measurement methods to two broad measurement methods. Now the current value has no limit. Any value which is there today can be used as the current value by any standard. So this is how the rules for the measurement have changed. Yes, Ali, any expected value is also included in the current value as per the new framework. Yes. Now the chapter number 7 is the presentation and disclosures, where we say that the effective communication of information in the financial statement makes information more relevant. This means that rather than only writing down the information, the mode of communication is also very important. So the new framework has focused more on the mode of communicating the information. Like for example, if I give you an information in terms of long paragraphs, you won't read that because you will get bored in reading that. But let's suppose if I give you values in terms of graphs, comparatively you are going to invest less time, but you are going to get more out of that. Or if I give you the values in the form of pie charts, that will be more understandable for you. So effective communication, not only communication, effective communication is very important from now onwards to ensure that it is relevant, contributes to more faithful representation, which means more better, true, and fair view, and will enhance the understandability and comparability, because paragraphs cannot be compared. Paragraphs cannot be compared as the last year. if you take two different financial statements of my company, it will be difficult for you to compare the paragraphs because maybe two different people have written that. So they might use different wordings even to tell the same thing. So it is very difficult to compare the wordings, paragraphs, but the tables, bar charts, pie charts, these are comparatively more easier to compare. So the mode of communication, if we use effective communication techniques, it will be more understandable and more comparable for everyone. Yes, Zabia, realizable value also comes under this, because realizable value is also something in today's time. Amara, you can take the snapshot quickly. Hussein is saying, please hedging if you have time. Hussein, let's see, cannot promise, but I will look into this if we can have another session on maybe Sunday. Um, Although it is difficult, but let's try. Hussein is saying thank you. Okay, I will try my level best, don't worry. And there was a question, Lao Hong was saying how to explain this chapter 6 measurement. Yes, Nabil, we can even do that. Basically, Lao Hong, what will happen in the case of measurement, if anything, in fact, let me show you a question to you people to make it more understandable that how the framework questions are actually going to be, so that we have a better understanding of that. So let me open a past paper question. It is December 2018. Let me go down. And let's say we are taking this question by the name of Phil. This is a 7-mark question. It says Phil is a coal mining company and sells its coal on the spot and future markets. So we are selling coal on the spot market. The commodity is traded for immediate delivery. In the spot market means that we are going to immediately deliver the coal to the customer. Milos is asking, sorry, where is question? Milos, basically, this is December 2018 question. I had shared these past papers in day 1, 2, and 3. Okay, good. So it says that, and on the forward market, the commodity is traded for future deliveries. So in case of forward market, we make a contract today and we deliver the products later on. The inventory is divided into different grades of coal, which means different quality of coal. Okay, and then it says further that one of the categories included in inventories at 30th November 2006 is coal with a low carbon content, which means that is of a low quality. Phil will not process the low quality coal until all of the other coal has been extracted from the mine, which is likely to be in 3 years' time. So this means we are going to sell this low quality after 3 years' time. Based on the market information, Phil has calculated that 3 years forecast price of the coal will be 20% lower than the current spot price. Now, the directors of Phil would like advice on two matters: whether conceptual framework affects the valuation of inventory and how to calculate the net realizable value. So does the conceptual framework affects the value of inventory? So let me write down the answer for this too. So this is the question of Phil relating to the conceptual framework. So we can say that as per conceptual framework 2018 chapter 6 measurement, it has mentioned two broad categories of measurement, which are historical cost and current value, where the current value includes different types of valuations or values, including the net realizable value. So this is how the question is asking, and this is how we are telling it that the framework does talk about it, but not specifically it is included in the current value. So we can say that different accounting standards then adopt the measurement rules as per the use of the asset. So this is how we are going to write down about the first part of the answer. Then it says how to calculate the net realizable value of coal, including the low quality coal. So we are going to say that as per IES 2, the net realizable value is the expected selling price less the expected cost to complete less the expected cost to sell. So in case of fill, the coal should be measured at the lower of the cost and the net realizable value. With respect to the low quality coal, it will be sold after 3 years, but when calculating NRV, we use the expected selling price of the current time, which is the value in the spot market. However, as there is a future market available, Phil can use the future price for the valuation of the low quality coal. So this was one of the examples of the framework questions that was being asked in the exam. And this actually related to the area of the measurement of the conceptual framework 2018. And do remember one thing, that some people may say, okay, this is such a small answer. It's not small. If you start writing it down, it is going to take comparatively double space on your paper and pen. So when you are typing, it comparatively takes less space. So this is not a small answer. It's a quite big answer for the 7 marks question. So what is important is that we should be using the relevant points rather than writing a lengthy answer. So you people can take the snapshot quickly so that I can get back to the presentation. Okay, so if we get back to the presentation, we started to discuss the presentation, the disclosures. So we were discussing that chapter 7 talks about the mode of communication, the mode of communicating the information. So mode is very important because that will increase the effectiveness, which will automatically affect the relevance. faithful representation, and understandability and comparability. This page, IODG, you want a snapshot of this? Yogesh, the answer that we just did will be the same in the old and the new framework because the NRV was there as well as here in the new and the old. So that's the same. Okay, IODJ, let me give, I will go back to the answer in a while. Let's discuss further first. Now the question says that effective presentation and disclosure requires to ensure that we are providing effective disclosures, we should be focusing more on the principles rather than the rules. What does this mean, focusing on principles rather than the rules? This means that let's say there's an IES which says that you have to write these 10 disclosures in the financial statements. Now, this is a rule of providing 10 disclosures. So rather than providing 10 disclosures, we have to see out of these 10, which of the disclosures are relevant to us. Maybe only 4 disclosures are relevant to us and the remaining 6 are not. So rather than following the rules of the standards, we should be focusing on the principles that to enhance relevance, what disclosures should be given and what should not be given. Yes, Salman, we can say that too. So right now we are talking about the principles of the disclosures, not the not about anything else. So classifying information by grouping similar items, like for example, we have a list of expenses and we are saying that we have 40 types of expenses. So showing 40 types of expenses to a shareholder is pretty silly because nobody would read 40 types of expenses. So we should group them off so that it's more easier for the user to understand that. And if we think that the breakup would be helpful, then a sub note, a further disclosure of that should be given rather than writing all 40 items in a single disclosure. So we should be classifying information properly by grouping similar items rather than writing them separately. Similarly, aggregating information appropriately means that sometimes we write a lot of expenses in the others or the other expenses. So if we aggregate a lot of items in the other expenses, that will that will reduce the faithfulness and the relevance of the financial statements or the disclosures. Getting this point? So we should be aggregating some of the information where aggregation is relevant. We should not be aggregating if not aggregating is relevant. We should try to group items and provide sub disclosures rather than writing everything in a single one. We should focus on the principles that what disclosures should be given and what should not be given rather than simply following the rules of the standards. And the next thing is that it's still about presentation and disclosures, but now we are talking about P&L and OCI. The previous standard was not talking about what items should be taken to P&L and what should be taken to OCI. So the new framework says that the statement of profit and loss is the primary source of information about the entity's financial performance. Therefore, all income and expenses should be classified in the P&L. The new framework is saying you should take everything in P&L. You should take everything in P&L other than some exceptional circumstances. So we say things taken to OCI are the exceptional circumstances. They are not normal circumstances. Normally, everything should be taken to the P&L. The board may decide to exclude from the statement of P&L income or expense arising from a change in current value of an asset or liability. The current value means the one that we have just discussed in chapter 6, measurement. So this means that any asset carried at historical cost cannot be taken to OCI. Cannot be taken to OCI. Only the assets or the liabilities which are measured at the current value, which means the present value or the realizable value or the expected value or the value in use, these are the values which should be taken to the OCI. Similarly, anything which is being paid from the bank is not a change in the value of the asset or the liability, so that can also not be taken to the OCI. Okay, Salman is saying, sir, cover quickly to get time for current issues. Salman, actually, the current issues are too much, and trying to cover that in very less time will actually make it more difficult. So rather than covering current issues in a short time, let's plan something for that on the WhatsApp group. Let's plan something. I'm thinking about that because a lot of students are being concerned for the current issues. So let me think over that, what we can do. We may keep a separate session. I may record a lecture for you people and provide on the WhatsApp group. So I'm thinking over the areas so that we can cover the current issues very well rather than just covering in a haphazard way. Thank you, Sanashid. Okay, so let's read further. So we say that all income and all expenses will go to P&L other than the exceptional items. There are some exceptional circumstances which will be taken to OCI, that the board will decide which things should be taken to OCI, but anything which is a change in the current value can only go to the OCI. Thank you, Muhammad Ali Khan. Salman Wasim, please drop me an SMS. I will reply to you tomorrow morning, inshallah, because I cannot show the WhatsApp group link on the screen. Maybe admin would help to message that to you in reply to this message. Admin, if you can, please. Cindy is saying, what do we mean by change in current value? Cindy, if I go back, this is the current value which we discussed earlier in chapter 6. This means that the fair value changes can be taken to OCI, the present value changes can be taken to OCI, the expected value changes can be taken to OCI, the value in use changes can be taken to OCI, the residual value changes can be taken to the OCI if the accounting standard says so. So the ISB board is allowed to take it anywhere where they feel better while preparing the accounting standards. So it is not an option for us. It is the option for the standard setters to decide where it should be taken to. And you just wait till tomorrow. I will add you there. I think admin has also shared the link to all of you people in reply to the question. So you would be having the link. You can copy that at least somewhere else so that if the session closes, you have the link slip still after there. Abdul Kadir, you can rewatch this from tomorrow. So let's conclude this. The board may make such a decision. Such a decision means taking to OCI. When doing so would result in the statement of P&L providing more relevant information or more faithful representation. So now if we see, all of the accounting is mainly based on these qualitative characteristics, the relevance and the reliability. The relevance and the reliability is the point on which major accounting treatments are being depending on. Now let's move on to the chapter 8. This is concepts of capital and capital maintenance. So this is again something entirely new. This was not there in the previous framework. It says that we have two types of capital. Either it is going to be a financial capital or it is going to be a physical capital. Now, what is a financial capital? Financial capital refers to the net assets or equity of the entity. Financial capital, Nimra, quickly take the snapshot. Financial capital means the net assets or the equity of the entity. And the physical capital means the productive capacity of the entity. Now, let me explain this to you. Let's say there's an entity A and entity B. Both of them started the business together by the same capital. Both of them started the business on the same date um, using the same capital. And now company A has a profit of 10 million and has one factory being operated. But company B has a profit of 2 million having 10 different factories. There are two people who started the same business at the same time. Company A is generating a profit of 10 million from one factory, and company B used its profits to expand into new factories, new industries, new products, new types of businesses. So B is having 10 companies, but because of reinvestment, it profit squeezed to 2 million. Now, if I ask you whose performance is better, A is better or B is better? Whose performance do you think is better? A's performance better or B's performance is better? Okay, mixed answers B and A. So the answer is, according to the financial capital, A is better. And according to the physical capital, B is better because B has more physical capital, more productive capacity, more capacity to earn profits in the future. And A is financially earning more, but B is generating more characteristics, qualities to gain in the future. Yes, lab, I will send that. Let me give you another example. Let's say after completing these 13 papers of ACCA, normally students have two options: either to go to the industry to use the knowledge and to earn, or go to an audit firm which pay less as compared to the industry, but there is more learning in the audit firm. So in industry we have more return, in audit firm we have more learning. What do you prefer, going to industry or audit firm? What would you prefer? If you prefer financial capital, you will go to the industry because you are going to earn more over there. But if you want to increase your capabilities, your expertise, your productive capacity, you are going to go to the audit firm. So different type of shareholders, different type of investors give preference to different type of capital. There are some investors who prefer financial capital, and there are some investors who prefer physical capital. So have we understood the difference between both of the capital? Thank you, IODG saying that was a perfect example, because that is something that you people can feel actually. So the examples that relates to you people is more easily understandable. So now, in case of financial capital, profit is made if the net assets at the end are greater than the net assets at the start. So we say that the profit is the increase in the net assets, or the increase in the equity is the profit for us. But from physical capital point of view, profit is made if the operating capability at the end is greater than operating capability at the start. So for both the type of investors, the priority is different, the profit is different. One says profit is earning cash and the other says profit is earning the capability. George is saying that are the current issues discussed in March relevant for September exams? George, the answer is no, because the current issues have entirely changed, only except one exposure draft. Only one exposure draft is the same as compared to the March, and everything else is different. Almost everything else. So we can say, yes, LIBOR 2016/1 ED is the same. So we can say that the concept of capital maintenance links the concept of capital and the concept of profit. By capital, we mean the financial and the operational capital, physical capital. The measurement of profit depends on the method used to value the capital. Whether we are profitable or not depends on the value of the capital that we are going to use. So if primary users means the investors, lenders and creditors, if the primary users are concerned mainly with the maintenance of nominal invested capital, which means financial capital, then the financial concept of capital should be used. So we have two concepts of capital: financial concept of capital, which says earn profit, focus on the profit. The other is physical concept of capital, which says focus on the operating capability. So the examiner can ask us that what is the difference between financial concept of capital and physical concept of capital. And in case of this example, along with the case, they can say that in case of this example, can you tell what type of capital are we focusing on? So we have to read the question and see whether the shareholders want profits or the capabilities. Based on that, we are going to tell what type of capital concept are they following. Okay, so actually that was all with the framework. So Alhamdulillah, we have we have completed the framework in today's session and we have completed the analysis in today's session. Now out of 4, we are done with 2. The areas left is the ethics and the areas left are the current issues. So let's discuss on the WhatsApp group of how we can actually cover these areas. Meanwhile, the ethics handout has been attached in the handout section. You can download it over there. I have just opened that. So in this, I have shared the handout of ethics describing what is the need of ethical behavior, what ethical responsibilities are there of the accountant, what are the 5 fundamental ethical principles of ACCA's rule book, what are the consequences of unethical practices, and how can we write these ethical responsibilities in the exam. And after this, we have 5 different questions of ethics: 1, 2, 3, 4, and 5. So these are 5 questions, 2 of the pilot paper, 3 of the actual exams. So based on these concepts of ethics, we can actually solve the questions. So let's discuss about these 2 topics on the WhatsApp group and then decide either we will keep another session or I will record these lectures beforehand and provide it to you people on the WhatsApp group so that you are more well prepared for the exams. So that was all, a quick overview of how to use the remaining days. Today was 30th, so now you have 31st August You have 1st September, you have 2nd September, you have 3rd September, and on 5th September you have the exam. So 4th is the revision day, so you should not be planning anything on day 4. So we can say that you only have 4 more days now. Only 4 more days left for the exam, which is not too much. And the areas that you people have to revise is going to be the consolidation. It is going to be the area of ethics, the area of analysis, the area of framework, all of the accounting standards, and at the end you will be required to revise the current issues. I would suggest to keep the current issues at the end and focus more on the remaining areas. I think the area of ethics is also covered in the March webinar, so you can also watch it over there. And if it is there, I will even download it and share it on the WhatsApp group separately. So do utilize these 4 days, invest time, because these 4 days are going to decide your next 6 months. These 4 days will decide your next 6 months. So it is very important to be composed, focused, and invest time on these studies so that you can pass this exam. In exam, I would suggest you people to start from the section A, solve question number 1, consolidation first, and then solve question number 2 that relates to the ethics. Out of these 50 marks, try to score 30 marks to 35 marks. This should be your target in section A, scoring 30 to 35, and this is an achievable target. This is an achievable target of 30 to 35 because the accounting standards in question 1 and 2 are comparatively easier than question 3 and 4. So if you are able to achieve 30 to 35 marks, this means in section B, you have to score 10 marks in question 3 and 10 marks in question 4. So if you are able to achieve 10 marks, this means you are in the range of 50 to 55. So this is going to be the target. On every mark, on every 1 mark, you have 1.92 minutes. So this means a 10 marks question should not exceed 20 minutes. A 10 marks question should not exceed 20 minutes. Keep the watch with you. Be focused on that, and based on that, you should be writing down the answer. Tasbih is asking if you want to become prize winner, then sir. Tasbih, then I would say that you only have to study 24 hours for the next 4 days. You can achieve that. Vishal is saying how to get those 4 marks. Vishal, you can get the 4 marks by giving headings, by writing paragraph forms, and using professional English. So these are the methods by which we can get the professional marks, which are 4 marks, 2 in the ethics question and 2 in the analysis question. Laiba, we are going to discuss this on the WhatsApp group tomorrow. And that was all for today, everyone. Thank you so much. And it was really good to teach you people. I hope the session was useful, and looking forward to meet you all in the current issues session, most probably, or otherwise in the video where we would not be able to interact. But still, I would be waiting for the feedback on the exam date, that how was the paper, and I will be waiting on the result date specifically to get to know that whether you people have passed or not. My prayers are with you. Best of luck, and that was all. Take care. Allah Hafiz.